In this video, we'll be discussing keeping price movements in perspective. We'll specifically be talking about information that's contained in the perspective worksheet in the S&P 500 Analyzer app. This video is provided by PolarisInvesting.com, a site for creating defensible valuations. As a reminder, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. Start off, I'd like to focus your attention here to the bottom of this perspective worksheet. Specifically, the range of returns that have historically been made across different asset classes. As shown, the S&P 500 index has made an average 7.2% annual real return. But factoring in inflation, the return is closer to 10%, which is the number most often referenced in the financial press. But when you look at what a typical investor makes annually, it is much lower than the average annual return of the S&P 500 index. As shown, the typical investor makes an average of only 2.6% real return, or with inflation, a nominal return of around 5%. This is half of the 10% nominal return the S&P 500 makes. There are many reasons why the average investor substantially underperforms. One of those is the type of investment vehicle that an average investor selects, which are primarily mutual funds that have relatively high fees. Another reason is the average investor chases returns. They get in too late. They often defiantly hold on to their investments and only exit them after substantial underperformance. They repeat the cycle of getting in too late and exiting too late. Investors tend to recall that the higher risk, the higher the return. But many investors fail to consider that for a level of risk, the return is an average return, and returns for that given level of risk tend to be normally distributed. And the higher the risk, the more discrete those returns tend to be. A lottery is an example of discrete outcomes. Outcomes are binary. A participant either wins it all or loses. No one makes an average return. In order for an investor to make an average return for a specific level of risk, they must make many attempts to allow the average to work out. Attempts can take the form of owning multiple stocks or allowing multiple time periods to elapse. As an investor's number of attempts increases, variance of their average outcomes diminish. Their outcomes regress to the population mean. Investors must stay invested in order to be successful. Time in the market is more certain than timing the market. Charlie Munger made a related brilliant statement. He said the first rule of compounding is to never interrupt it unnecessarily. Investors tend to overestimate the impact of skill and underestimate the impact of luck in investment performance. Investing is particularly a lucky activity in the short term, with results driven more by luck and boldness than skill. There just isn't a likely way to determine market behavior in the short term. There are too many market participants operating under vastly different approaches. The following picture shows a continuum of activities as they relate to luck versus skill. Far right, chess is considered to be a very skillful activity. Next to that is basketball, where height is a significant skill. The average height in the NBA is 6'7", yet only 2% of the population is taller than 6'4". All the way to the left is gambling, specifically roulette. And somewhat surprisingly, investing is also considered to entail a lot of luck. Not only does stock investing involve a lot of luck, because of the uncertainties involved with investing, you need to consider that over the last several decades, investing has increasingly been dominated by large institutions. Instead of picking individual stocks themselves, investors predominantly invest in mutual funds, delegating stock selection to professionals. This has resulted in a further narrowing of limited investment skills, resulting in luck being the dominant factor. This is known as the skill paradox. The saying, "the harder one works, the luckier they become," implies that skill and luck are interchangeable. But actually, skill and luck are separate factors. The saying, as it applies to investing, is about increasing the number of attempts rather than reducing uncertainty. The more an activity is based on luck, the faster the outcomes revert to the population mean. Reversion to the population mean is a powerful force in investing. The James-Stein Estimator function is shown in the bottom left of the picture. It demonstrates the impact of mean reversion. The larger the degree of luck, DOL, the more an individual's average outcome will regress to the population mean with more attempts. Using chess as an example, with a degree of luck of 0, the winning percentage of an individual will not regress to the population mean. Compare that to roulette at the other end of the spectrum, with a degree of luck of 1. There, the winning percentage of an individual will totally regress to the population mean. The exact degree of luck is difficult to determine for most activities. Investment skill versus luck is extremely hard to determine because it requires a large number of observations, typically over many years. Statisticians require at least 370 observations in order to have a 95% confidence that outcomes are not just from luck. If investment performance was measured once a quarter, it would take 90 years to conclude if investment performance is from just luck or not. Even if investment performance is measured monthly, it would take 30 years, which is the majority of an investment career. Recently, in a Wall Street Journal article titled "Investment Success Takes Time," suggested that it takes at least 18 years to determine if an investor performance is from skill or luck. Uncertainty is unavoidable in investing. The fee of market returns is angst. As such, an investor will inevitably encounter a streak of bad luck and market-wide downturns. An investor must faithfully execute a process because in investing, process trumps skill. Regardless of how much investment skill an investor assumes they have, there is no denying that luck plays a large part in investment performance. Willingness to accept systemic random outcomes and individual luck is the main differentiator of a successful investor. An investor must remain resilient. Investors tend to be overconfident, particularly about their own risk tolerance. When asked, most investors say they are disciplined long-term investors. But in the moment of market uncertainty, most investors become risk intolerant. They abandon their disciplined approach and are driven by greed and fear. Returns across the stock market tend to be normally distributed, but with fat tails, sometimes referred to as the volatility smile. As shown in this graph here of the Russell 3000 distribution of stock returns in a given period. You see here that 64% of the stocks had a lower return than the index, and 36% of the stocks had returns higher than the index. But at the extremes, you had almost 20% of all stocks with returns of less than minus 30%. At the other extreme, you had almost 5% of stocks with above 30% returns. A recent study by Professor Hendrik Bissenbinder of Arizona State University showed that just 20 super stocks out of roughly 26,000 stocks since 1926 have accounted for 25% of the wealth generated by the stock market. 100 stocks accounted for 50% of the wealth generated. 300 stocks accounted for 75% in a mere 1,000 stocks, which is just 4% of all stocks, accounted for all the wealth generated. This is a little bit misleading because all the companies acquired by a company are reflected in the report as a single acquiring company. Despite a few issues with the report, it does correctly point out that returns in the stock market tend to be concentrated with relatively few winners and many losers. The chart here at the top of the screen shows the S&P 500 index returns from 1926 through 2017. The pie chart to the right shows that about 3/4 of the time the S&P 500 index had a positive return, and about 1/4 of the time it had a negative return. Looking at the year-by-year magnitude of the returns, you notice that the returns are rarely an average of 10%. Here to the right, the chart title, Returns Are Almost Never Average, shows the distribution of the S&P 500 index returns from 1926 through 2014. It shows the returns were between 8 to 12% only 8 times over the 88-year period. Important to remember that the S&P 500 index has an average return of around 10% nominally, meaning including inflation, but returns are rarely average. As we discussed in the pie chart, you need to keep in mind the pattern of returns. In the charts worksheet, the pattern of S&P 500 index returns is shown to be 21.8% for 4 consecutive years, followed by 1 year of minus 30%. This results in an average return over the entire 5-year period of 9%. Well, returning to the perspective worksheet, you see that yearly returns don't always exactly repeat this pattern. There are periods where there's negative returns for several years, but on average, the pattern is every 3 to 4 years of significant positive returns of around 20%, followed by 1 year significant negative return of around 30%. Now, this 4 or 5 year cycle is surprisingly consistent. It tracks the economic business cycle. And to get appreciation for just how regular this cycle is, many studies show, like this one here, show how long a typical significant downturns last and the magnitude of those turns. You can see here that the reoccurring ups and downs and the lengths of the ups and downs work out to about 1 every 4 or 5 years, with an average drop of 30%, with in between increases of about 20%. Here's another study that shows the same kind of things in terms of how regular the downturns are and the magnitude of the downturns. This table over here shows you kind of the historical points throughout the life of the stock market when the downturns occurred. And this chart here talks about how relatively remarkably short significant downturns are. When you have a significant downturn, it's usually about 2.5 years of length of time of which the market continues to go down, but then it just takes merely about a year for it to recover. So total duration from a significant downturn through recovery is 3.5 or so years. Now here at the top shows another view of the ups and down cycles that have occurred in the market, going all the way back to the 1920s. Now the question that comes up is, what are the drivers of the business cycle? Well, there was a paper written back in 1976, a professor named Hyman Minsky from the University of St. Louis, called the systemic fragility. In that paper, he discusses the instability hypothesis, which is a concept that stability seeds instability. Stability leads to extreme optimism, which leads to excessive risk-taking, which leads people to take on more debt, and the market essentially gets overheated. So the Federal Reserve responds to that by trying to cool off the market by raising the risk-free rate of return. The market eventually pulls back and moderates its risk-taking, resulting in a reduction in the amount of optimism in the market. The Federal Reserve, in response to that, will then lower interest rates. And then sometime after that, the market will begin to get overheated again. So the stock market is a leading indicator of the economic and business cycle. Interesting to note that as early as 1935, John Maynard Keynes, in a book called General Theory of Interest, Employment, and Money, made similar observations about market instability. He said it's from spontaneous optimism, or Pollyanna, animal spirits with a propensity for action. So the prices are set by irrational masses, particularly during abnormal times, resulting in fluctuating opinion, primarily from people having what's known as presentism, or over-focus on what's happening right now in the market. There's now some consensus on terminology, not 100% agreed upon, but overall most people in the financial industry agree to terms to describe what's going on in the market. You have the term pullback, which typically means something around 5% drop in a major index like the S&P 500 index. A correction is when you have more than a 10% drop. A bear is more than 20%. A crash is more than 30%. You can see here that historically, how often does a pullback, correction, bear, or crash occur? A pullback actually can occur several times a year, but with a recovery probably within a month. A correction happens about once a year, with the recovery taking an average of 3 months. Bear market is like we've already talked about, every 4 or 5 years or so, with a recovery of anywhere from 6 to 18 months. And then a crash is very rare, maybe once a decade, and it can last up to 2.5, even approaching 3 years. We also have, very rarely, it's called a severe crash, which is a drop of 50% or more. And that's likely going to be something that an investor will see once, maybe twice in their entire investment lifetime. And from a severe crash, you can take up to 30 months or 2.5, 3 years to recover. Now that we talked about long-term cycles, let's turn our attention to short-term price volatility, namely the volatility that's less than a year. On a monthly basis, 30% of the time, or about a third of the time, you'll see a month-to-month price change around 2%. About 40% of the time, you'll see a month-to-month change of 2 to 5%. And then 20% of the time, you will see a month-to-month change exceeding 5%. Now, on a daily basis, most day-to-day changes are going to be less than 1%. So that occurs 70% of the time. 95% of the time, changes are less than 2% per day. Another way to look at daily volatility is about once a week, you'll have a change of greater than 1%. And over an entire year, you'll maybe see one time a daily change of more than 5%. A couple other things to keep in mind about short-term volatility. One is that typically only 0.5% of outstanding shares for a particular stock are traded in a day. Looking at it inversely, that means 99.5% of outstanding shares do not trade in a particular day. The majority of the time, stocks trade below their all-time high. This chart here in the gray shows that for Dow Jones Industrial Average, but the same applies for all kinds of market indexes and for most stocks, is that it shows in the gray that the times the Dow Jones Industrial Index traded at least 5% below its previous all-time high. And you can see here that over 90% of the time, it traded at least 5% below its previous all-time high. Another thing to keep in mind is a common index to look at is the S&P 500. But the S&P 500 index, in terms of number of stocks, represents less than 8% of the stocks traded on the New York Stock Exchange and NASDAQ combined. The S&P 500 index does represent, though, over 70% of the market capitalization of all stocks. 60% of all stocks traded have a combined market capitalization of less than 3%. And a third of all stocks don't even trade a single share in a given day. Now, a plausible explanation for short-term price volatility has to do with the nature of the traders that are out there on day-to-day trading stock in the stock market. Some studies have shown that the makeup of traders in a given day is about 20% of the traders are known as methodical or disciplined investors, also known as fundamental or value investors, who consist of realists and optimists. Realists focus on facts, looking to increase their odds. Optimists thoughtfully consider future possibilities, looking to identify major shifts early. The remaining 80% of market participants are considered to be more algorithmic, who are more focused on price than value. It's always assuming that there's always going to be buyers and sellers. And out of these algorithmic traders, about half of them, or 40% of the total market, is very mechanical, meaning that they're constrained. They have locked in investment rules. Examples include index tracking funds, pensions, and university endowments. They have very specific trading rules and criteria that they use. They attempt to minimize the amount of emotion included in their decision making. The remaining 40% of these algorithmic traders are high-speed day traders that use technical analysis and just simply try to take advantage of moment-by-moment price volatility in the marketplace. Sometimes refers just the mob. They trade throughout the day, driving second-by-second price fluctuations. They are particularly active at the beginning and ending of the day as they take and exit their positions. Now, some high-speed traders are very focused on just the bid-ask spread difference and attempt to make money that way. But the other high-speed traders are speculating on likely second-by-second moves in the market. So the majority of the trades in a given day are done by these algorithmic traders. Now, this is shown also in another statistic that has to do with average turnover in a fund. Going back a couple decades ago, the average turnover in a fund was about 6 years, but now it's around 10 months. And for individual investors who tend to be more focused on short-term trading than they are true investing, some studies have shown individual investors are trading out their stocks as quickly as every 3 months. This results in a lot of trading in the market. It really is just noise and often not based on long-term value assessment. It should be noted that Benjamin Graham considered investment for a time period any less than 5 years as being speculative in nature. All right, last thing we want to talk about is seasonality of volatility, and that's shown at the top here, that mostly stock returns happen kind of randomly throughout the year, but you can see somewhat of a trend in the summer months, namely May through September. The markets tend to be a little bit lower. That goes with the saying that, sell in May and go away, and then there's other things about the Santa Claus rally in November and December, and even the January effect. Overall, not much difference between returns in the different seasons. Well, this has been a video about keeping daily stock price movements in perspective from both a long-term and short-term view. Well, thanks for watching.